Okay, so I'm not sure if the camera's gone a bit wonky. So is that
I can't tell you till you come on. We'll be in a
okay?
second.
Well, anyway, welcome to our YouTube live. I probably think you might be able to see just a quarter of my head.
It's fine. It's fine.
Oh, it's okay. It's just a preview. So yeah, thank you for joining us, and we're going to be on for an hour. So we'll have plenty of time to discuss questions, and obviously we'll favour people who are our Patreon supporters, but also YouTube supporters. And we'll be able to tell you're a YouTube supporter because you've got a nice crown next to your name. We've now got 80 YouTube supporters who've joined us on YouTube. Some people just don't like Patreon, so if that's the way you want to support us, that's great. And once we reach 100, we're going to do a special session just for you, our our YouTube supporters. And that way, we can kind of say thank you to you, and maybe that can be a regular thing. So please do.
And they can super chat.
Oh, and you can super chat as well. So that's the other way to jump to the front of the queue. So hello, everyone. Hi, Ceramis. Lovely to see you. And I will talk about GameStop shortly. And Andrew Lester, lovely to see you. Kenneth Adams, hi. Sunita Lokhande, hi. Anton Belev, hello. Epic Arif, hello. And Jambo Unchained, hello. So yeah, nice to see you, and welcome to the YouTube live. So we're going to be on for an hour, and let's start with some of your questions now. So first question about GameStop. So let's have a quick look at the GameStop share price. I'll just share my screen so you can see this. Right, and GameStop. There we go. So here's the kind of exponential growth in the stock price, and then the exponential decay shortly afterwards. So we're back down to about 60. And so it seems like this has been a kind of round trip to a high price. Now, I mean, the general story with these pump and dump schemes, and in retrospect, it was a pump. The people who would have sold at the top would have made a huge gain, particularly if they'd have bought it with options. Unfortunately, by the time many people cottoned onto the trade, they'd have bought up at 360, 380, and now they'd be nursing a significant loss. And if it was with an option, it could well be 100% loss. So that's the drawback of these schemes. If you get in early, then you're okay. But for many people, I think it's been a quite unpleasant experience. And for those who do say that this is an undervalued stock, what I'd say is, it's a loss-making stock. So what is the value of that stock? Is somebody coming to come around and turn around the stock? Is it a sector which is in structural decline? Probably, because they didn't really get onto the online sales bandwagon. And now, with something like Stadia, I can just stream this stuff. I don't even need a console. So, that business model is kind of you have to call it into question. Some people like physical games. Personally, I just find it easier to just stream stuff when I'd like to play. And I can stream it on my phone. So I've got a Pixel phone, So I'm not convinced that it was a cheap stock. But on the other hand, I did have a look at a couple of the comments on on GameStop, but also the stuff on silver, because there's a tag on Wall Street Bets, which is DD, which is due diligence, and some of the articles are pretty good. I used to read a lot of research published by investment banks because I was at an investment bank, and my colleagues published single stock analysis, and some of the stuff on there is kind of very good. It's professional quality research almost. I mean, obviously it's not as good as the stuff you get at an investment bank, but it's not written for that kind of professional investment money manager audience. It's written for, regular people. So I think there's a real skill in taking knowledge about a particular stock and its profits and its prospects and turning it into something which is kind of readable and digestible which other people can profit from. So I think from that point of view, Wall Street Bets is really good. Some of the research is excellent, but then you get some of these more questionable articles, which are really just a way of kind of pumping up the value of the stock, which really don't serve much purpose at all, other than making some people rich if they can con other people into buying the same stock. So I hope that none of the people watching got burnt in that sell-off. Say in the comments if you did, because it would be interesting to hear your perspective on it, or if you made a lot of money with one of those calls off Wall Street Bets. Also share it with us. I'd love to know how you performed. But GameStop now, I think the other kind of take on GameStop is that these meme stocks are pretty much the difficulty is that if you have more than one at any given time, it can only generate so much flow. So if there's disagreement on Wall Street Bets about which stock to go for, there's a limited flow, which is going to push up the stock price. So it only works if everybody has a huge consensus on one stock. And I think that was the other difficulty. And in the video I did on silver, the silver squeeze, which never happened a few days ago, in that video there was actually a slide in that video where I showed somebody suggesting that there was a conspiracy theory that this was a deliberate attempt to take attention away from GameStop by mentioning other stocks like ATC or Nokia or Neo. And that way not as many people would buy GameStop, and then it wouldn't rally so much. And of course, there have been difficulties with the actual plumbing of the financial system, where the margin requirements for Robinhood were so high that they actually had to stop people from owning the stock. I don't think there's any kind of conspiracy there. I think it is literally just a matter of too much risk of the deposit of the exchange where Robinhood was placing its bets. So there was a nice interview which was done by Elon Musk on with Vlad, who is the CEO of Robinhood, where Vlad actually just laid out the reasons for the clearing house to raise their margin, because the volatility was so high. And the margin requirement was so high that it just became impractical to trade the stock. So I guess that's one of the drawbacks with being very innovative. Essentially, you have to rely on this kind of very old infrastructure, which other people provide. Robinhood itself just has to exist within that ecosystem, and it's all very well disrupting, but you have to use everybody else's infrastructure to do that. And if the plumbing's broken, you're not going to design a whole new system of plumbing on the old plumbing system. So ultimately, it comes down to plumbing. Okay, so that's my plumbing take on GameStop. So do like us, do like the stream. It helps us a lot, even if you're watching it in playback. It would be great if you could like the video and like the stream. And if you do want to jump to the front of the queue for a question, just do a super chat or join us. If you join us, you'll have the little crown next to your name. And Clara, what am I talking about? This is the second time. Just to elaborate, just to explain, Clara's my daughter. Okay, Laura will shout out if she sees you and you've got a crown next to your name. Somebody thought something dodgy was going on last time. Who's Clara? Yeah, that's my daughter. Okay, so next question. Let's go on to oh dear. Okay, so Ceramis said, I lost about £1,500 from GameStop. I'm sorry to hear that. Oh, here we go. This is a good one. Super Charlie Clark says, well, I'll just go through this question because it's kind of interesting. Somebody asked me about this today. Would you recommend a career in an investment bank? Now, when I used to work at the investment bank that I used to work at, whose name I won't mention, I was part of the business university, which meant that we taught a lot of grad students all about investment, but also all of the products which the investment bank was trading, about hedge funds, about the players in financial markets, lots on derivatives. This was for the trading desk, the sales desk. So we really had to know everything inside out. It was a great way to learn, but I really enjoyed that interaction with the grads. And so one of the things I actually do sometimes is I mentor people who want to get into investment banking, because obviously I worked for investment banks for a long time. Would I recommend that other people do it? Probably not. You know, if you are a very talented person, go and do something useful. You know, if you're an engineer, go and do engineering. If you're a physicist, go and do physics. A lot of those skilled people get sucked into investment banking, and I think, you know, you'd probably be better off. You'd make society better by doing what you're skilled at, rather than being sucked in by the money. But yeah, investment banking is a good career. I loved it. I just loved the intellectual stimulation. The people that I spoke to on a daily basis were really interesting people. The clients I spoke to were usually fund managers, pension fund managers, hedge fund managers, and they were great, really interesting people. And yeah, I really enjoyed it. But it's not for everyone. Long hours, obviously, and some pockets of the culture are still fairly toxic, fairly sexist, some of it racist, you know. I mean, but on the whole, lovely people, very bright, and I loved it. So yeah, I think investment banking is not for everybody, but if you are just starting out and you want to learn about it, or maybe you need some help with it, you know, get in touch if you're young, and you know, we can talk about it. Okay, let's move on. Sunita says he's a long-time watcher. Thank you, Sunita. That's good to know. Best financial content on YouTube, LB. Thank you. Andrew Lester says, good evening. Good to hear you on Moneybox this week. Yes, I was on Moneybox. I didn't actually say the name Pensioncraft. That was obviously a mistake. But I was on Moneybox complaining about spam comments in YouTube. So YouTube, obviously, we have a lot of people who clone our channel and then make comments as if they were us. So that's really annoying, and that's what it was about, cloning of our channel, which is very frustrating. Regular listeners won't have been taken in by the scammers. True. Bonds, I struggle to see the value there at the moment. Your views? Well, this is a frequently asked question, I've got to say. In fact, I just did a video for Patreon members about Chinese bonds, because some people, for example, Bridgewater, have noted that if you buy a developed market government bond, and let's have a look at the yield on US 10-year government bonds, and I'll just pull that up here on Fred. Let me just share my screen so you can see this. Here we go. So the US 10-year Treasury is 1.144%. Let's get it on Fred. Here we go. So Fred is a brilliant resource if you haven't used it already. So this is the 10-year rate on US Treasuries, currently 1.1%. And if we look at its historic range, obviously in the 1980s it went up to about 15% when inflation was high during the Volcker period. It's come down massively since then, but currently obviously not yielding much. Whereas if you go for something like, C-Bon is what I was trying to get. C-Bon is an ETF issued by Van Eck, which looks at which buys Chinese government bonds. Okay, that's not going to work. So let's say I'm an individual investor. And yeah, so this buys Chinese government bonds, and obviously the yield here is 235 basis points above that of the US. Why? Because it's an emerging market. So, I mean, one way to get an increased yield is to go for Chinese government bonds, or you could go for government bonds. You could go for emerging market government bonds. So this is ETFDB. And here you can see emerging market government bonds where, if you go for EMB, the yield on that will probably be around 4%, I expect. So much higher than you'd get for developed markets because you're taking a credit risk. And there are all sorts of other risks which you have for emerging market bonds. If they're issued in US dollars and emerging markets suffer a crisis where they may not be able to service their debt, then you could get an emerging market debt crisis. In fact, that may be one of the fallouts of the pandemic that we start to see in the months ahead. And if that happens, then obviously the credit spreads on these bonds would widen, which means the prices would fall. Also, people would pull their money out of these bonds and the prices could fall. But the expense ratio is not too bad, 0.39%, and the yield is probably considerably higher than it would be for developed market government bonds. So 3.9% is the current dividend yield. So if you put in $100, over the last 12 months, you would have received $3.90. Whereas if it was treasuries, you'd have only got about, $1. So 4 times as much income. But you're obviously taking a greater risk in order to generate that. So it really depends on which government bonds you go for. If you go for emerging markets, you get a higher yield. But if you go for developed markets, very little. But the point is also that if you go for developed market government bonds, they do hedge equity. So if you do a scatter plot of the daily return of, say, the 10-year Treasury tracker, like IEF, which is issued by iShares, plot the daily returns of that on the x-axis versus the daily returns of the S&P, and you'll see that it's negatively correlated, even now. So if people tell you they're no longer a hedge, yes, they are. Just plot the returns, and you'll see for yourself that they still diversify equity. And it's a hedge which you're paid to take. That's really unusual. If you hedge with options, with puts, you have to pay a premium. If you hedge with treasuries, the government pays you to hold a hedge, which is great. So that's one of the benefits.
YouTube supporter question.
So I will answer that. Okay. And what was it? Is it on Slack?
It's on Slack.
Oh, okay.
Do you want me to read it?
No. I've got it. I invested in Bailey Gifford, American, at the start of 2019, and also thank you for supporting us, I should say. And I'm wondering whether to take profit. I'm nervous the market's overvalued. On the run your winners debate. I mean, personally, I think if you do believe in that fund manager, the difficulty is that there's always a reason why markets will go down. Always. Valuations are high. There's a trade war. There's political instability. There's too much debt overhang. The Fed might raise rates. There's always a wall of worry. There's always a reason why markets could sell off. And we can't time these crashes. And that's the reason why people say, just run with the profits. Just hold a fund forever. Because if it's performed well through this cycle, then there's no reason why it shouldn't continue carrying on doing well relatively in the future. So if you do believe in the fund, hold on to it. If you think the fund is no longer managed well, that could be a reason to sell. But if you're just kind of nervous that valuations are too high, remember that valuations can stay high for a very long time. So that's probably not a good reason to sell. And, I did a video, I think it was 2 videos back, where I looked at whether you could use enhanced CAPE yield, which is Shiller's new measure of valuation, to decide whether to hold money back from the market. And you can't. You can't really time markets. It doesn't really work most of the time. So similarly, I'd say you can't call when these markets are going to sell off. So it's probably best to just run with the profits you're getting with the fund. If you are getting nervous, you can always rebalance your portfolio. If you've got some bonds in the portfolio, just rebalance And the simple act of rebalancing will mean you're reducing your Bailey Gifford American Fund. So that's probably an easy way to reduce your exposure. But, you know, if it's successful, it'll probably carry on being successful in the future. Momentum is a theme which it's certainly a factor which tends to do very well, because success tends to breed success in markets. So yeah, I'd probably stick with it. But if you are getting nervous, just rebalance, I'd say. Okay, time for a swig, I think. So please do like our stream, and you can share on Twitter. So you can share on Twitter or whatever social media you use. Tell other people about it. That would be great for us. Or just like it. It's really easy. You just click on the like, and even if you're watching it in playback, that would be great. So next question. Kenneth says, good evening, Ramin, and thank you. Do you think it's true that the banks, government control the precious metal market? Seems rather scandalous if so. Interesting question. I mean, I just did this video on silver, so I'm kind of, that's at the front of my mind, so I'll just talk about that briefly. What the stories were, in fact, for the last decade, there's been a rumour that JP Morgan has been short the silver market. So even 10 years ago, there was a Guardian article which I found which said, if you want to break JP Morgan, the bank, buy silver, because that'll squeeze them on their short silver position. Maybe it was true then. Could it be true now? No, because there are no longer people at investment banks who take very large directional positions on commodities, on stocks, on credit, on bonds, because proprietary trading, or prop trading as it's called, simply blew up the banks too often, right? It was a very volatile source of income, and you'll see many banks are now moving towards a wealth management model where, say you manage $1 trillion of people's wealth, you earn 1% of that $1 trillion every year. And that's a much more steady source of income, and it doesn't blow up the bank. So there's a reason why prop trading stopped. It was because it was not very reliable as a source of income. Oh, there's a member question.
No idea how that worked.
Oh, somebody's just joined. Thank you for that, Barish Palaska. Thank you for joining us. He obviously clicked on the join button. Thank you for that. So is it true that banks are manipulating the commodity market? Obviously, they're market makers. So if you buy gold, there'll be a gold trading desk at investment banks, or almost every investment bank will have one. Will they be able to manipulate prices? Well, they wouldn't stay in business if they were consistently manipulating prices. And it was one of the things that JP Morgan got in trouble with was spoofing, where let's say you want to push up the price of gold. What you do is you put in lots of buy orders, which you then cancel over the space of milliseconds. This is kind of high frequency trading stuff, and that pushes up the price of gold. And then, you know, if you're a long gold position that you've got, that would push up the price of gold, which you can then close out that position, for example. Or if you wanted to push it down, you'd spoof it with lots of sell trades, which you'd never execute on. So by manipulating the trading books in those ways, you could have, and investment banks, some investment banks did manipulate gold markets. But would that affect the gold price over the next month, over the next year? No. Ultimately, it'll find its own level based on supply and demand. So I think it's unlikely that investment banks are manipulating the price of precious metals. So no, I think that's just a conspiracy theory. And frankly, I think the culture at investment banks has improved a lot compared to how it was even 15 years ago. Compliance is just much more important. And if there were some bad eggs, generally, they've either retired or been fired. There'll always be some level of dodginess, but there's not as much as people are making out, I'd say. Carolus Geodevicius. That sounds like a Roman name. Brilliant. What's your prediction of inflation in Europe, including Eurozone, for 2022, 2023? Well, it's interesting that the inflation rate went up recently in Europe. Obviously, one of the problems that the European Central Bank has had for some time has been very low inflation. So I don't know if I'll be able to find it very quickly, but let's have a look, see if we can find the European rate of inflation. Here we go. So it has a slightly comedic name of HICP, which is hiccup. And let me share my screen. Hopefully you can see this. So this is the harmonized index of consumer prices, and here it is for Europe. Now, I don't know if you can see value at the moment. So at the moment, it's minus 0.3%. So that's as of December 2020. So it's minus 0.3. So it's deflation rather than inflation. And if you break it down by the type of which part of the consumption basket we're talking about, you can see the deflation is happening in all of the pandemic affected sectors. Transport is cheaper because fewer of us are flying or traveling on public transport, so the prices have dropped. Interesting that communication has dropped, given how much we're having to rely on that as a service. Clothing and shoes, obviously, if you're stuck in the house when your gym jams, you're not going to be going out to buy clothes, whereas alcohol's gone up. So that paints a fairly awful picture of what we're doing. We're wearing pajamas and drinking booze in our houses. Obviously, we're still eating, so food and beverage prices have gone up. But overall, these two things pushing in different directions have pushed inflation into negative territory in Europe. Now, do I make forecasts? No, I don't. I don't make forecasts. I just teach people how to make up their own mind. But what I'd say to you is, why not make your own forecast of what's going to happen based on that consumption basket? So what do you think is going to happen as we get the vaccinations, as the pandemic starts to ease? What do you think will be the effect on that consumption basket? My expectation would be that, people would go out more, they'd travel more, and that'll push up inflation for the travelling services. And I'd also expect fuel prices to increase because there'll be more demand for fuel and energy prices would increase. And things like restaurants, for example, will have more business and probably more demand for their services. So I'd expect this to be a temporary blip, the deflation. I'd expect it to go back up to closer to 1%, which is roughly where it was before. Maybe overshoot because there'll be a lot of activity, a lot of pent-up activity, pent-up demand for some of the services that we've missed out on during lockdown, going out, traveling, holidays. But then it'll kind of fall back to normal, which is around 1.5% in Europe. So I don't think there'll be a massive spike in inflation. I've made several videos about inflation. If you're interested, just Google pensioncraft inflation to see them. But I don't think we're going to see crazy inflation.
There's two supporters' questions. I've posted one, I'll do the other one.
Cool. Mill Lee says, what do you think about minimum volatility? Also in comparison to other factors such as value. Okay, so I had a minimum volatility fund and it underperformed horrendously after the pandemic. So why did I choose that? I chose it because I was scared of volatility. I'm very cautious. My circumstances at the time meant that, I really couldn't afford a capital loss at that point. So I'm kind of okay with that. But the logic behind minimum volatility, the reason why historically it's done quite well, is that the beta which is how much you multiply the market movements by to get the return of the fund. So beta of 1 means that if the global equity goes up 1%, your fund would go up 1%. If beta's half, then you'd have a lower risk because the equity market would go up 1%, your fund would go up 0.5%. Lower risk, lower return. Or if it's beta 2, it's like a leveraged position. What's nice about minimum volatility funds, some of them, is that when there's a downward move, the beta decreases. So you see less, you feel less of the downward moves. Whereas when you get a very sharp upward movement, the beta is still not quite 1, but it's less than the beta on the downside. So you participate more in the upside of equity markets and participate less in the downside. That's the logic behind it. Because the type of stocks they buy in a minimum volatility fund, firstly, they diversify each other. They're uncorrelated. That's what they usually go for. And secondly, they're boring stocks. They're fundamentally boring. Things like the utility sector, things like non-cyclical stocks like consumer staples, which sometimes pay a high dividend. So that's the kind of environment where that would do well would be a market in which it's trading sideways and it's kind of whipsawing up and down, for example. You'd expect minimum volatility to do well, or even if it's trending downwards slightly with lots of volatility, minimum vol would probably outperform a broad market index. But as we saw, what we got after the March sell-off was I saw a brilliant description of it. It's called pandemania. So it's kind of like there was a kind of mania for stocks following the pandemic and during the pandemic. And in that kind of environment, the stocks which have done best have been high volatility, high cost, so expensive stocks have actually performed better than cheap stocks. Growth has done incredibly well. Anything which is in ARC has done well. So that kind of ticks all of those boxes. So it's kind of the opposite of minimum volatility. So if you think markets are going to be range bound for a while with high volatility, that might be an environment for minimum volatility. If you think we're going to see all of the beaten down stocks recovering, so that would be sectors like energy, perhaps cyclicals like banks, or maybe anything else which has been affected like the restaurant sector, the travel sector, airlines. In that case, you'd go for value because those are the sectors which have been smashed down. They've recovered somewhat, but they still haven't recovered completely. So that might be the kind of thing to go for. I hope that answers your question. Was there another one?
No, somebody answered it for them.
Oh, okay. Right. Kenneth answered. Tricks and tracks. Hi, Ramin. Will the time of day, time of the week my SIP executes its purchase affect my returns? That's an interesting question. Yeah. So let's say you place a trade and it's kind of aggregated with everyone else's trades. Does the time of day affect the price it's executed at? I'd answer this in two ways. First of all, yes, it does matter. When markets are less liquid, when there's a point in the day when there's a lull in trading, there may be a widening of spreads, in which case you'll probably get a slightly worse price than you would during, say, the 10 a.m. surge in activity, which you see every day. So it really depends on time of day. Yes, it would affect the bid and offer spread, But would that matter to you is my second part of the question. Because if you are a long-term investor, 0.5% slippage in the price of the stock is not really going to matter. It's not going to make a big difference to your long-term returns. So, what I'd say is it shouldn't matter. And if it does matter, you're doing it wrong because you're not going for the long-term view. So I really wouldn't worry about things like that because if you are going to hold a stock for a very long period of time, it doesn't really matter what time of day your fund manager, your platform trades. Right, so Teddy obviously is nominated himself for a trick because he's just come up and said hello. So I'm going to give Teddy a treat. Obviously I haven't prepared very well today because I haven't got the treats ready. Here he comes. You ready, Ted? You ready? Are you ready? Goodness. Oh, very good. Over here. Over here. Oh, very good. Well done. Well done. Right.
ADD, who's one of your supporters, just said thank you with £5 as well.
Oh, that's really kind of you, ADD. That's very good. Thank you very much for that. Okay, so back to the questions. Ian Davies says, "What are your views on current gold and silver prices? If you're a member of the Patreon community, then you get access to our fundamental fair value model for gold and silver. Gold is currently about 20% undervalued. Silver is roughly at fair value. So that's based on 3 factors. One of them is inflation, the CPI measure in the US. The other factor, the second factor, is real interest rates in the US. So obviously when interest rates are high, gold becomes less attractive, so does silver. And then the third factor is the strength of the dollar versus a trade-weighted basket of its trading partners. And obviously when the dollar's strong, that's bad for gold because gold is priced in dollars. So a high gold price means a weak dollar because they're measured relative to one another. So that's the way the models are built, both of them. And as I say, if you're a Patreon member, you get access to that. And you can play around with it yourself. You can copy the spreadsheet, try changing the variables to see how it would affect the price of gold. Okay, so do like our stream, that would be great. There are now 351 people watching, only 150 likes. If this is helpful to you, please do like the stream. It's very helpful for us. Even if you're watching it in playback, that would be great. And Giuseppe Calvi says hello from Italy. Buongiorno. And Ivor, hello. Ivor Sexton, how are you? Ian Monaco, hello. Fardian says hi, looking younger each day. I wonder if you're talking about me. I really am not looking younger each day. Daniel Sarolu says hello. Also gave a like. Thank you, Daniel. I appreciate that. Joel says, hello, Ramin. What are your thoughts in general about ESG? Particularly on MSCI, ACWI, IMI, disruptive technology. Well, let's have a look at that while we're talking. So let's have a look. And this might be a good way to kind of talk around it. So that's just share my desktop. So hopefully you can see this. So this is the fund you're talking about, I believe. So this is the way these funds are constructed is they take a parent index, in this case MSCI All Country World Index, which is about 85% of the stocks you can buy in developed markets, 23 developed markets and 8 emerging markets. Then what it does is it selectively chooses stocks where the companies are involved in something like a disruptive technology. So this is kind of similar to what happens for an index like or a portfolio like ARK. The difference is that this thing can be tracked passively very cheaply. So let's look at some of the names here. I'm not familiar with many of them, but for example, CRISPR Therapeutics is also ARK funds. Okay, so or it could be something like a biotechnology company, or it could be an energy company which is presumably using solar energy based on the name. I'm not familiar with it. But so that's the way these are constructed. What is noticeable is look how many stocks are in this index. Only 212 versus about 9,000 in the parent index. Also, notice there's concentration in certain sectors. So the information technology sector in the global index would be about 23%. Here it's double that. So there is a lot of sectoral concentration here. Healthcare is about 36%. And then things like energy and materials are much smaller. So kind of interesting. This is almost like a kind of ARC light, which is also cheaper to track. So you could buy a passive fund which tracks one of these indices, and you could probably pay much less for it than you would for ARC, which is 1%. So this kind of ticks a lot of boxes because it's both ESG filtered, so it doesn't buy things like alcohol companies, alcohol brewing companies, or arms manufacturers, or maybe nuclear power, but it does buy things which are seen as positive in many ways. So often these disruptive technology companies are seen as, good for the environment, or they transform some part of our lives to make our lives better. So there's a lot of feel-good factors here. And the even better thing is that the performance of this fund is considerably higher than the non-ESG, non-disruptive version of the index. So just as ARC funds have done incredibly well since the sell-off in March, so has this passive index. So for example, if we wanted to find a fund which tracks it, we could look at it on ETFDB. Oh dear. ETFDB. And we could look for a fund which tracks that theme. If I copy that as well. And just see if there's a tracker for that index. Okay, I don't think there's one for that particular one. It couldn't find one. But I assume there is a tracker. If there is, just pop it in the comments and then other people will be able to see it. But I assume there is a tracker for it. The technology gods didn't help me by letting that search work. So yeah, I think that's an interesting fund. I like it. That's one I might even consider investing in myself. Interesting.
You've got a member's question on Slack.
So off to Slack. Baruch Palaska, our new member. Thank you. Our new supporter on YouTube. What's the effect of the meme stock frenzy over the overall stock market? Does it make a potential stock market sell-off more or less likely? Okay, again, I did a video about kind of related to this, but let me just briefly explain my logic when it comes to this. And if you don't follow me on Twitter, maybe that might be a good idea, because I sometimes put stuff in threads. And I actually made a thread on Twitter, which I'll kind of go through here, just to kind of explain my thought process here. So what I was trying to do is explain the effect of gamma on markets. And don't be scared, gamma is not scary, because I'm going to explain it to you and you'll hopefully understand it after we go through it. So this is the thread, and let me just share my screen so you can see it. And where are we? Yes. Right. So this is the thread I'm talking about. So firstly, value investing, right? So what does value investing do? If a stock is underpriced, you buy it. If it's overpriced, you squeeze volatility out of markets effectively. What's happened is that many people have been buying call options or put options in this new retail world, in which retail investors buy a lot of upside or downside via options. So let's say you want to push up GameStop stock. One way to do that is just buy the stock. Another way to do it is to buy call options on the stock. What's cool about that is that it gives you a leveraged position in GameStop. And what it makes the hedge fund, what it makes the market makers do on the other side of the trade is go out and buy the stock. So let me just explain that. So this is what happens if you just own the stock. You make money 1 for 1. If you buy Apple stock, it goes up 1%, you make 1%. If it goes down 1%, you lose 1%. So that's called a delta of 1. If you buy an option, it only gives you a right to buy stock. You don't have to exercise that right. When you reach the maturity, the expiry of the option, you have the option to buy the stock, but not the obligation. And that means you only buy it if it's above the strike price of the call option. So let's say you've got an option to buy Apple at, say, 130. Then you'll only exercise that if Apple's trading a little bit above 130, so you make your premium back. Because you have to pay up front for the option because you can't lose on it. But there's a fairly high chance you'll lose money on the option because you've paid a premium up front. If it's not above the strike price at expiry, then you lose all of your premium. You lose 100% of your investment. But usually it's just a fraction of the stock price that you pay up front. So this is what the payoff looks like for the call option. So let's say that the strike price is around 140. You don't lose on the downside because then you don't exercise the option. So you've immediately truncated your loss to the premium you've paid, which is about $11. Whereas you've got unlimited upside on the call option. If you add volatility value, which is the actual value that you might get because the price is jumping around before expiry, the hockey stick shape gets smoothed out into something looking like this. So this is your unlimited upside, that's your truncated downside, and the option costs you $11.50. So you start off with a loss, which then falls as the stock price rises. If the stock price doesn't rise, then you just lose that premium of $11.50. So the person that sold you the option has a payoff like this. So they've got $11.50 because they sold you the option. And their job as a market maker is to keep that money. They don't take a directional bet. What they do is they buy the stock, because you can see here the slope is negative, which means that if the stock price goes up, the options market maker will lose money. So they have to buy stock to counteract that slope. And this is what the Black-Scholes formula does. It tells you exactly how much stock to buy to flatten out that curve. So now notice that the curve is flat around the current share price. So they've had to buy stock, and they now have a payoff that looks like this. If the share price goes up, they have to sell. If the share price goes down, they're long and they have to. Sorry, if the share price goes up, they're short and they have to buy. And if the share price goes down, then they're long and they have to sell. So if the price rises, they have to buy. If the price falls, they have to sell. And that means the market maker is amplifying market movements. So let me just repeat that. The market maker is now amplifying volatility. If the share price goes up, they have to buy more. If the share price goes down, they have to sell more. So that activity is destabilizing markets. So if there's lots of option buying, this creates the requirement for investment banks to lay off their risk. They do that by delta hedging, and the consequence is that they amplify market volatility. So I think the upshot of this is if there's more trading of options by retail investors, which there is now, that makes markets more unstable. It's amplifying market volatility, and that's bad for most of us. Okay, so that's the kind of take home I think from this activity from GameStop. So this is the actual graph from the FT, which shows how much call option trading activity there's been since the year 2000. So you can see call options didn't really take off until the lockdowns and the pandemania after March, and now it's just gone crazy. So there's a huge amount of call option trading, which has just injected a huge amount of gamma into markets, which then has to be hedged by delta hedging, and that makes markets unstable. So I think all of that risk that's been injected into markets has to go somewhere. It doesn't just disappear. And unfortunately, I think that's made markets more unpredictable. And if there is a move upwards, for example, it amplifies it. If there's a move downwards, it amplifies it. So that makes it much harder for most people to invest. So I think that's a problem. And I think that's going to be the kind of long-term legacy of more people trading options, unfortunately.
There's a question on Slack for you, and then another one.
Oh, okay. So we've got some questions.
I haven't posted one yet. Read that one.
Kyle. Yeah? Kyle Baker.
Yes.
So Kyle says, what do you think of the effects of negative interest rates would be on the FTSE 100? Okay, well, it's kind of interesting. The Bank of England said that they're not going to do negative interest rates, or at least they're not planning to. But they've actually planned for what they might have to do, hypothetically, if they did have negative rates. So certainly people are not expecting them to do negative rates. If they did do negative rates, then in theory, it would be good for markets. But the reason why they did it would be bad for markets. Let me explain. The reason why rates are so low is to stimulate the economy. And if they're making rates even more negative, that suggests there's a much deeper problem, structural problem with the UK economy. And if that's the case, that would worry people. And that probably means it's a bad scenario for equity markets, even though low interest rates typically are a good story for equity. So that would be my concern. Also, if rates become more negative in the UK, that would tend to weaken sterling. And as we tend to import a lot of stuff in the UK, in particular oil, that would be a problem for part of the UK economy as an importing economy, I think. So, yeah, I think it would probably be bad news if they were lowering interest rates to negative territory because the economy was in worse shape than we'd hoped. Okay, I hope that answers your question. DD says, do you have a view on Troy Trojan Ethical? Are there any other funds to look at to take a bit more of a defensive stance? I'm not familiar with Troy Trojan Ethical. There are some funds which explicitly are designed to take a defensive stance. Ruffer is one of them, for example. So Ruffer buys call options on the VIX. Some people call them 10-cent because they buy out of the money option positions on VIX. Remember, what happens in a sell-off is the volatility index goes up, VIX goes up. If you've got a call option on VIX, that goes up. And that means the hedge, which they bought very cheaply, pays off. So in March, for example, they did incredibly well because their cheap out-of-the-money call options on VIX paid off handsomely. Another thing they've started buying recently is Bitcoin because they see that as a tail hedge for very high inflation. So very high inflation is very unlikely, but if it did happen, they think that Bitcoin would provide them with a hedge. Personally, I think that's unlikely to be a good hedge. I think inflation-linked bonds would have been a much better hedge. I think that's mistaken thinking on their part, but hey. But that's another defensive fund, for example. Or, another boring version of a defensive fund is a bond fund. Buy government bond funds because they are defensive. They tend to rally when equity markets sell off. Or if you can, you could go for something which gives you exposure to volatility, like Ruffer, like Ruffer's fund. So those are your choices. So that's probably the best way to go about defensive funds. Or you could go for something which is an equity fund, but which has lower cyclical exposure. So it explicitly goes for defensive sectors. Things like utilities, non-cyclicals like pharmaceutical companies, because we still have to get medicine when the markets are in a downspin and the economy is weak, or things that we have to buy, like, Walmart would be an example of a place where people still carry on spending in a recession because they still need to eat. And so those would probably be the sectors you'd go for. So you could do it via sectors, you could do it via currency. So currencies that tend to do well in a recession would be things like the dollar, the yen, Japanese yen, or the Swiss franc. So equities in those three currencies may be a hedge slightly. That might be another way to play it. There's various ways you can do that. Okay, so we've got 5 minutes. We're running out of time. Remember, if you are a Patreon member, then almost all of your questions get answered on a Sunday evening call. That's the difference. And there aren't so many people on the call. Currently, we have over 400 viewers. Typically, on one of those Sunday evening calls, we only have about 50 viewers. So that's the benefit of being a member. Please do like us. We've only got 228 likes, 400 viewers. So please do like us, even if you're watching it on playback. And time for another treat for Teddy, I think, before we finish. Oh, he's been waiting so patiently. Come on, Ted. Oh no, that's the lazy way. Stand. There we are. Very good. Oh, he's so good. Brilliant. He actually wrote that Twitter stream on derivatives. He's the expert. I just talk about stocks and bonds. Okay, so we've got time for a few more questions. Interesting one again. Do you think retail brokers will be punished for the market manipulation they enacted over GameStop? I don't think they'll be punished, actually, because, as I said earlier, I think the reason why they had to stop people trading certain stocks was because of the clearing companies, the clearing, the places where they clear the trades require them to post margin for the stocks which they trade. And if the volatility goes up for some of those stocks hugely, then they have to post more collateral, more cash. And they had such huge margin calls from the clearing company, I think it was DTCC, that they just couldn't afford it. They had to actually recapitalize the company to the tune of billions. I think it was over 3.5 billion in order to be able to post that margin. And that's just not practical. It was much easier simply to say to people, look, you can only sell these stocks, you can't buy them. So I don't really buy into the conspiracy theory that it was pressure put on them by some of the market makers to stop people trading those stocks. I think it was just the financial plumbing which forced them to do it that way. And, they're not really culpable for that. I think what they are kind of responsible for is gamifying trading. I think people no longer care about valuation. They see investing as a get-rich-quick scheme, whereas it shouldn't be. It shouldn't be exciting. It shouldn't be seen as a game. It should be boring. If you're excited when you trade, if you're excited when you're investing, the chances are that you're speculating, not investing. It should be like taking out the rubbish, taking out the trash, or like washing up the dishes. It should be boring when you invest. And I think they're responsible for making it exciting, which is not good for most people in the long run. So I think that's where they're culpable, because they created this culture in which you want to trade lots of individual stocks, even though for most people you're not going to be able to choose stocks which outperform. And secondly, they try to make it exciting. And they allowed people to trade on margin, and they allowed them to trade derivatives, which, as we see, is ended badly for many people. But will they be in trouble for that? No, because it's not illegal to do that. One more question. what's your view on inflation? No. World index. Okay. Okay, let's end on this one, which is by Rashid Suleiman, who says, why do central banks target inflation of 2%? Why not 1% or 3%, for example? Some people have actually suggested they change it. And you'll notice the Fed has slightly changed the way they approach financial stability. Their actual remit usually is simply stable money. So we don't get hyperinflation, we don't get deflation. If you actually plot the value of stocks, the average price to earnings ratio on stocks versus inflation, you'll see that it represents a kind of Mexican hat, a kind of Gaussian curve, if you're a mathematician, with a peak at around 3%, 2 to 3%. Why is that? That's because if inflation is too high, it's bad for companies. Companies can pass on inflation as long as it's reasonable, but if inflation gets too high, those input costs go up for the company and they can't pass it on to their clients, and it reduces their profits. And if you get deflation, there's a lack of demand, usually, which triggers it, which means less demand, less earnings for the companies, more companies going bust, and that's generally a bad situation as well. So 2% is roughly the sweet spot for inflation. If you look at market valuation, for example, that's just one of the reasons. Another one is that, historically, when inflation's around 2%, then as long as you're not kind of out of kilter with other economies, so as long as you're not kind of at 2% and everyone else is at a different rate of inflation, then that's not necessarily a problem, right? But 2% is not set in stone for any economy, and it could change in the future. It could be lower or higher. So, for example, the Fed changed it so that it's an average of 2%. So if it's under for a long period of time, under 2, they'll probably let the economy run hot for a little bit of time. That's their new way of approaching monetary stable money, as they call it. But that could change. So yeah, let's stop it there. We're 2 minutes past 8 o'clock, so I usually try to keep it to an hour. Thank you all for joining us. Remember, if you do want a one-to-one with me, you can always book a power hour, and you can join us on Patreon. So that way you get to join our calls. You get to join us on Slack and chat with us and ask questions. And the third way you can support us is directly via YouTube by becoming a YouTube supporter. And there's a join button underneath this video, so you can do that very easily. And you don't have to go via Patreon, which is one click further away. So thank you all for joining us. And I hope you enjoyed the stream, you found it useful. And see you again in 2 weeks' time. Take care, everyone, and good luck with your investments.